Greetings, it's time for our monthly inflation update. Now, as you know, I have a 3-variable inflation assessment that is very comprehensive and holistic because you have to get around what the media does as well as the people desperate to believe that inflation is higher than it is, which is cherry pick either a short time window that's convenient to the narrative or cherry pick anecdotes such as the price of butter rose or the price of eggs rose or the price of the S&P 500 rose like that's a bad thing. So I maintain that a 10-year horizon is important, and the average annual growth rate over a 10-year horizon is the correct structural measure, not whether inflation was high for 3 months because the same people are nowhere to be found when inflation is low for 3 months. And I say all three of these numbers have to be above 3% compound annual growth rate. The US CPI compound annual growth rate has to be above 3%. The Goldman Sachs Commodity Index compound annual growth rate has to be above 3%. This is the most important measurement because it is worldwide, and it is a composite of commodities that are freely traded. So this entire bogus narrative of how inflation is understated deliberately is entirely demolished. That narrative is discredited completely when one looks at the Goldman Sachs Commodity Index. And then the 10-year US Treasury Yield, that has to be above 3%. So unless all three of these are above 3%, only then do I say inflation is above optimal. If all three of these were at 3%, I would say inflation is optimal because too low inflation, meaning deflation, is also negative unless you have deflation in the Goldman Sachs Commodity Index because that is an unmitigated good, but deflation in the US CPI and the US Treasury Yield would not be good either. So 3% would be optimal. Higher than that would start to become less optimal, but it's not a panic point if it was 3.1, 3.1, 3.1. And much lower than this is in fact an indicator that more money printing has to be done, more quantitative easing has to be done. So let's go to the Goldman Sachs Commodity Index first. Goldman Sachs Commodity Index, and the 10-year compound annual growth rate of the GSCI is minus 0.77%, deflation. And that is because oil is lower than it was 10 years ago, gold is the same price as it was 10 years ago, natural gas is also pretty low, silver is also not rising at all. All these commodities combined are in deflation, as one would expect in a technological economy. So all the whining you hear about inflation is completely invalidated because commodities are in deflation over a 10-year window. This is pretty volatile. It can go from deflation to inflation pretty fast, but again, it is in deflation and has been throughout most of the lifetime that I've been tracking this indicator. Now we go to the US Treasury Yield. 10-year US Treasury Yield is at 3.535%. 3.54%. So it is above 3%. There's a lot of resistance at 3%. You see how it took a lot of force to go above 3%. It was unusually low during COVID-19, and then it started to hit the ceiling of 3%, and it couldn't break through for a few months, and then it finally broke through because the Federal Reserve is raising rates far too quickly. This, of course, is very, very burdensome for the U.S. housing market, and if it stays this high for very long, there will be both a U.S. housing market crash as well as a crash in the U.S. Treasury market, which will greatly inhibit the U.S. government's ability to do deficit spending. But right now, this is above 3%. And remember, this is an indicator of expected future inflation, even though the other two indicators are indicators of past inflation. Now we go to the last one, the BLS.gov website, where we see the US CPI. US CPI at the BLS.gov website, which is in the description box below. So to see the 10-year compound annual growth rate, you have to take this number, 298, divided by this number, 232, because that shows the inflation over 10 years, and then take the 10th root of that, and you can look at earlier videos to see the math regarding that. I'll come back to this in a table we're going to look at in a minute or two. Now, the 1-month inflation level is dipping very low. This flurry that was briefly high is already in the past. It's already negative. 2-month has also moderated down to nothing. 3-month has also moderated down to nothing. 6-month has also moderated down to an equilibrium that existed for the last 10 years. Only the 1 year has not already moderated down because the earliest months of the last 12 months, so months 7 through 12 ago, are the ones that are high, but it's already dipping down very decisively because all the shorter duration numbers are also dipping down. So this 1 year annual CPI rate, it was high for a very short time. All that media screeching you heard about was due to a very temporary phenomenon. So now we go back to my 3-variable inflation measurement. So US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and 10-year US Treasury Yield. What is the answer? Today, on January 17, 2023, the 10-year US CPI compound annual growth rate is 2.5%. Goldman Sachs Commodity Index is in deflation. I cannot stress this enough. Minus 0.77%. Deflation. And the US Treasury Yield is the only one of the three that is above 3%. Unless all three become above 3%, which is a very low bar for anyone who actually talks about historical inflation. This is a very low bar for all three of these to be above 3% due to the correlations associated with them. Inflation is not starting to get high, and this would actually be optimal inflation. This is, in fact, a little bit low in commodities and an indicator that money printing should resume. But the US CPI is still at 2.5%. So no, inflation is not high. I will debate with anyone about that because I know what all their arguments are, and their arguments are very anecdotal, very emotional driven. That's why we've come up with this video that you see in the upper right hand corner, Kartik's Law of Inflation, where I make fun of this cultural meme of exaggerating inflation into something far, far worse than it actually is. Now let's go to that table of inflation duration snapshots for some further enlightenment. People always talk about that 1-year inflation rate because to them only a 1-year time window matters because they want to cherry pick their data to support a bogus narrative. Time periods shorter than a year don't matter, and time periods longer than a year don't matter. I say the 10-year rolling window is what matters because that smooths out small amounts of aberrational noise. Now, the most recent reading of the US CPI was negative, minus 0.1%. That means on an annualized level, that would mean deflation, but 1 month, of course, is too short of a sample size. So it's 2 months, but that is 0. 3 months annualized is 2.0%. 6 months annualized is 1.8%. I hope everyone understands how this is annualized. Take 1 month and take that to the 12th power, 2 months to the 6th power, 3 months to the 4th power, 6 months to the 2nd power, a square. 1 year, the CPI reading for the last 1 year is still 6.6%, but it's dropping quickly because all these shorter month series are so low. There was only a very temporary flurry of inflation that is already in the past. It is silly that people are still whining about inflation. The average inflation rate over 2 years is 6.6% because there was 13.7% over 2 years, therefore per year that's 6.6%. Over 3 years there was 15.1% inflation, which is 4.8% a year. Over 5 years, 19.7% inflation, which is 3.7% a year. And over 10 years, as we saw, 28.4% CPI inflation, which is 2.5% a year CPI gain. This brief upward blip has been more than canceled out by periods of unusually low inflation in the past, notably in 2015 as well as 2013. 2.5%. So all that screeching about inflation is very innumerate. You are dealing with someone with extremely poor math skills when they say that inflation is high because only the last 1 year matters, or inflation is high because the price of butter rose or the price of eggs rose, or because their wife's boyfriend's parole officer said that inflation is high, therefore they have to believe that inflation is high. It is quite pathetic to believe something like that and to be the type of person who gets caught up in a nihilistic cult of inflation when there is nothing to worry about on that front. You're extremely fortunate to even be someone who lives in the 21st century, yet you are depressed about some high inflation which is absolutely non-existent. I've been saying on Twitter that inflation has become for conservatives and libertarians what the patriarchy is for feminists. Something that is greatly exaggerated in its power and its malevolence. Both are myths that are non-existent, and therefore conservatives and libertarians on this subject of inflation and money printing have become as anti-intellectual as feminists have become on matters of gender relations. So inflation is already negative in the second derivative, and there are enough months of low inflation that indicate we are more in danger of slipping into deflation than having high inflation in the near future. And then money printing will resume again. So I hope you found this video to be informative, and if you like this type of content, then I encourage you to subscribe to this channel. Thank you very much for watching.